Hello and welcome to the Weekend Investing Daily Byte of 1st of July 2024, and the markets continued the rally forward. The discussion we will have today is on PE ratios. Are we being misled by PE ratios? Are we making bad decisions based on PE ratios? But we'll discuss it second half of the video. Nifty carrying on after Friday's mild pullback. Nifty has closed yet again at 24,141, up 0.5%. It is becoming almost a tiring exercise for people to watch Nifty go up. Those who are sitting in patience with their portfolios, not wanting to, do any churning or have any action, are sitting very peacefully. Those who have been wanting to time the market post the elections and did not get in on that dip day post the election results have been waiting. The wait is getting longer and longer, and the markets are pulling away from the averages more and more. So the long-term averages, 50-day moving average is at 22,800, and now the markets are at 24,141. Of course, there will be some pullback at some point of time, but right now the markets are in no mood for that pullback. Nifty Junior also gaining good 1% today. So you can see that a move that was going up consolidated, and now it has started to build that up again, and potentially will be going to a new high. So up nearly 1% today on Nifty Junior. Mid caps breaking out of that range, another 1% added to mid caps on 21,000. However, I must add here that the same stocks are not rallying. So after this consolidation, there has been a different stocks that are rallying, and mostly those stocks that have not rallied so far in the market are the ones which are now being pushed forward. So it is going to become slightly more riskier from that perspective, that those stocks are getting the push, which maybe they were not meant to go up, but because they have not kept up with the market, they are being pushed up. Small caps, fantastic gain at 1.5% for the day, moving out of this range that we have been watching since the last many days. Bank index also up, but not as much, 0.44%. So not moving the way other large cap indices were moving, but nevertheless, a good recovery from those 2 days of fall. Today's heat map: HDFC Bank takes the lead again at 1.2%. Bajaj Finance up 2.2%, TCS, Infosys, Wipro all up. So IT stocks doing really well. Cement stocks doing really well. Ultrasemco doing 2%. Grasim up 2%. And others like ITC, Levers, Nestle also doing quite well. So good gains on most Nifty stocks. And in the Nifty next 50 heat map, you had again the public sector enterprise stocks, REC, PFC, HAL, BEL move further up. And Motherson, Siemens, ABB, the capital goods pack also moving up. And you had Bajaj Holding, ICICI Pruli, Ambuja Cements, Vedanta, Shree Cement. So cement stocks after the India Cements transaction are pulling up extremely rapidly. You had some losses in public sector banking names. So Canara Bank, PNB, Bank of Baroda, all were down a bit. Tata Power down, IRFC down, and Pidilite along with Varun Beverages also down a bit. FIIs and DIIs, FII is virtually absent from the market in the last uh, session, minus 23 crores. So you can't even see the light blue line, but DII is very much uh, in the driver's seat at almost 6,600 crores of buying by domestic institutions. So all is looking good from the fund flow perspective going forward. Sectoral trends, as I mentioned, PSU banks losing 0.8% the most. Now, over a month now, PSU banks have not made any gain. Whereas if you see the private banks, they've made 8.2% in a month. So suddenly, within a month, there has been a complete opposite change in terms of how banks are moving. Earlier, PSU banks were the darlings in the banking space, and now it's the private banks. But private banks for the last 12 months are nowhere near 14% versus 78% on the PSU banks. Real estate also has been languishing. Last 1 week, it has lost 3%. Energy stocks also not able to move up, down 0.5% today. In the last month, gaining only 3% here. But IT stocks has been the flavor of the week, the month. 13.8% on IT stocks, and 2% just today itself. So IT is coming back. The US markets, the US tech stocks have been doing well. And on back of that, I think IT has been a preferred segment to boost the Nifty also. FMCG up 0.7, metals also doing well 0.7. You had consumption stocks 0.5% now, and now as the budget month has started, there will be stories about income tax cuts on some slabs, and consumption stocks may become the front runners for many weeks. Auto stocks up 0.5% on on every first you have auto numbers come out, so in anticipation of those numbers, auto stocks also up, and you had public sector enterprise stocks also clocking 0.4%. Over the last week, except IT and potentially infra stocks and energy stocks, nothing really has worked much, but it's good to have a flattish sector also rather than something going down. IT, you can see, is almost uh, a very round, sort of a inverted head and shoulders kind of a pattern here. The natural targets are here. It's come off very, very sharply from the bottom, almost 20% jump already in the last few weeks. On the longer term time frame also, you can see it is rallying towards this top, and beyond this top also, I think a lot of room can be covered if they intend to go there. Nifty MNC index has been going up quite rapidly. You can see that only for some time during October 21 till 23 March was there some range bound rest. Other than that, it has been extremely robust, and people are betting on MNC stocks like never before. Stock spotlight is on Cholamandalam Finance. It's up 11%. Again, it was creating a very nice roundish bottom, sort of a consolidation here after having rallied from 500 rupees to 1200, and then this consolidation came, which was almost a year in making, and then it has broken out, and suddenly from 1,000 rupees we are at 1,609. So a fantastic gainer. On the long term also, you can see that this was the sort of the breakout line at 740, which had the inverted head and shoulders kind of a pattern, and which also essentially had a target of about 1250, which it achieved within a few months itself of breaking the pattern right there. So coming to this PE ratio story, so a lot of folks in the market focus on the PE ratio, and you have to pardon me for my uh, lack of knowledge on this subject, because I don't watch PE ratios. Neither do any of our strategies has any link to any PE ratio based metric. We do not watch PE ratios, and or for any fundamental metric for that matter. But a lot of folks in the market, especially those who are beginning to invest in the market, look at PE ratios and decide on investments based on PE ratios. So there is, of course, merit to that, but there is a lot of demerit to it also, and I'll try to showcase that. So in 2021-22, the way in which we calculate the Nifty PE ratio has changed from standalone to consolidated. So strictly speaking, a 22 PE ratio now is not comparable to what it was earlier, but it is not too far off also. So if I were to just see this chart, and this is from peratio.com, I don't know if you're able to see it, but let me, yeah, there is a line chart also. So this is the red line is the Nifty index, and this is how the PE ratio of the market has changed over a period of time. Uh, the median PE ratio has been around 21, and if you see just one, even if you ignore the last 4 5 years for some time's sake, you will see that the PE ratios used to rally from a bottom of 10 or 11 maximum, usually to 22 23, and in some extreme years to 28, but it used to remain in this range of 15 to 18. But suddenly now that range has entirely shifted up, and it has become 20 to 30 in this range. In fact, on the previous calculation basis, it also went to 42 post COVID. So from all these perspectives, and if we just don't compare with previous regime also, and just see the last couple of years, even then you will see that despite Nifty going up so much, because the earnings are catching up so tremendously, that the PE ratio has not really changed in the last few years. So if we are now at 22.85, 2 years back we were also at 22.5 or something like that. So from all those perspectives, uh, the current PE ratio is the same as what it was 2 years back. So you really can't say that market has really outrun what it was few years back. But the point of the matter is that the entire range has shifted. So this absolute number actually has stopped to make much sense. Even those who watch this number, because I know folks who are sitting in wait of 12 price earnings for the last decade, and they have not been able to buy anything because they are living in this era of their mind that a extreme down market will bring the PE down to 10 or 11 or 12. Whereas in COVID, we saw the market virtually went half, and the price earnings was reduced to 17.5 at the bottom. So if you were waiting for 12, you would not even be able to buy, even if another COVID drop type of market was there. So this is very, very misleading when you look at it on an absolute basis. But when you look at it on a relative basis, you are able to see that Nifty is pretty much where it was last many, many years. And this is not just India market. This is the PE ratio for the US market, and the chart is that of last 150 years. Here also it is very, very clear that the US markets used to trade between 10 and let's say 2022 for most part for almost a century. That has been the range of the play, except maybe the just before Great Depression. But in the last few decades, that range has shifted above, and now, minus the 2008 GFC, it has never come below 20, and it is now ranging between 20 and 45. So if US market with virtually no growth overall versus India at least can trade at 32 times, then India at 22 or 24, wherever it is nothing out of the box or abnormal from that perspective. So it is always a relative position that you have to see. And within the deeper discussion, you can see that if the overall price earnings of S&P is, let's say, whatever, 32, then that 32 is made up of 495 93 stocks which are below 18 or 19, and only 7 of them are above 45. So all these numbers are extremely getting skewed because of a few stocks, and the absolute number of that ratio itself has gone, in my view, largely meaningless. And if you will pick up stocks which have high PE ratios today, of course, they are there need to be very high growth stocks which can, deliver doubling, tripling kind of profits every few years. Uh, but what you will see is that the stock prices there will are the ones that you really want. And if you are looking at stocks which have dead price earnings ratio, those are the stocks that will not do well. That has been the sort of revelation when I was looking at starting momentum investing more than a decade back. That you can find value, but the value stocks will only move once momentum enters that stock. So that is the key. That don't worry about the PE ratios, worry about the trends in the stock, and worry about your exit plan. And if that is in place, PE 20, 40, 60, 80, 100, 200 does not matter. Let me know your thoughts. Thanks. Bye.